Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Japanese index, the Nikkei, is down 2.5%. The Kospi trading just below the flat line.
Mexico or for Canada, no, the tariffs, they're all set. They go into effect.
Down about 1.7 on the S&P. Nasdaq down about 2.6, 2.7%.
But the Nifty has gotten to that zone where it could see some kind of buying and some kind of bottoming out.
Potentially, right at the beginning of this kind of tit-for-tat escalation.
0.5% on the Nifty. So 22,000, around 22,000 right now.
This is a fair value market. The excesses of the past has been corrected.
Financiers who have been prudent from the beginning are continuing with the same policy.
Markets, there has been a remarkable recovery.
Loan growth is expected to moderate as per analysts' estimate in many segments of NBFCs except gold loans.
Prime Minister explored various facilities at the centre and also closely interacted with various species of animals which have been rehabilitated there.
It's all engineering. That is been the stock of the last few minutes, a 20% lower circuit after that downgrade.
Good morning. That was the day so far. Good afternoon.
Yeah, not morning anymore, Rima.
Good afternoon and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Rima. With me is Nigel and Surbi. And that intraday recovery that we had in the first 40 minutes of trade is we're holding on to it so far. So the Nifty is above 22,000. Still mildly lower on the benchmark indices, but the mid-cap index, small-cap index in the green, and we've got a positive advanced decline ratio. Hi, guys.
Hi, absolutely. And I think Nigel and I were discussing this in the morning, and it's played as per script because that's exactly what you were pointing out. That given that this market is already so beaten down, what could have been otherwise a very brutal day with the kind of headlines we woke up to has actually turned out to be okay. And who knows, by the time this closes, maybe we're in the green.
Well, the factors were in place, right? We are bouncing from oversold levels. That's not yet changed the structure because the structure continues to remain weak. But a much needed relief rally is what we're seeing. The Nifty is down only around 30 points and the broader markets, the breadth of the market is good. And I think should be that red top trade did the trick as well. I told you, whatever you wear, the market will do the ulta. And for now, we have a higher amount of green on the screen.
Yeah. I can wear red every day if that helps.
Hello. Yeah, just make sure. but it's a far better looking screen. And actually, a couple of factors are playing in for India out here because when you woke up this morning, whether you looked at your WhatsApp groups, you look at Twitter, you look at everything, everyone was talking about much lower levels. People are throwing in the towel, which actually was a sign that actually things are bottoming out. And also Brent crude prices, the last I checked, it is sub $71 per barrel. That's a macro tailwind, and we like that very, very much. And in addition to that, the Nifty is already down 15%. So while the globe was celebrating, we didn't really take part in that. And for the time, we just take a look at that. Brent now sub $71 per barrel. That's a kicker for India.
And Europe, by the way, is down and sharply lower at opens. So the CAC...
After rallying a lot in the last few days.
Yeah, yesterday it was sharply higher. And today there is that unwind taking place as investors are bracing for the impact of Trump tariffs, which go live on Canada, Mexico and China, and the fear of retaliatory tariffs. China has already announced a 15% import duty on certain U.S. goods, and they've also added 15 U.S. firms to the export control list. So investors are bracing for the impact. In Europe right now, frontline indices are down more than about 1%. Asia has largely closed in the red. Nikkei is down 1.2%, Hang Seng down close to about a third of a percentage point, but they too managed to recover quite a bit from the day's low. Shanghai actually is in the green now in terms of closing. But what should you do right now? Is it time to stay on the sidelines? Is this a buying opportunity? Last hour trades with Mitesh now up for you. So Mitesh, good afternoon. All the action took place in the first, 45 minutes. Then things turned quiet. Markets moving in a tight band. And once again, you're seeing some buying interest. So what's the approach? On the index, are you getting more confident to go out there and buy?
Good afternoon. I'm still waiting for, some kind of a reversal to be triggered. We've not fallen today is a good thing, but I was hoping that the bank nifty at some point in time will clear 48,400. It didn't happen. It attempted first around 10 o'clock and then again around 2:15. We got a high of 48,355 and 375 respectively. But I think, once you get the price to, start getting and capturing some supply pivots, I think that will show strength and just not suggest that this is, just a bounce back from oversold level. So that trigger is still pending for me. But a lot of stocks, I think, are showing good traction. So we'll take some long positions over there or suggest them. ABB for me is a buy with a stop at about levels of 51.30 for targets of 53.80. And the other one which I like is the Chola Finance. That's one stock which is not corrected. It's been making fresh highs. So buy here with the stop at 14.34 for targets of 14.80.
Okay, all right, Mitesh, got that. Thanks very much. We'll come back to you for some more trades. By the way, Mitesh, before I let you go for now, just a word on the two-wheeler majors, the biggies. There's a big slide that's underway on Bajaj Auto and Hero Moto. The numbers were weak for February, we know that. But just technically, how do these two look?
Extremely oversold, Surbi, but they've broken all the weekly and the monthly averages as well. Bajaj Auto, if you look at it, peaked out in September at 12,775, and since then it's nearly down about 40% plus, and there's still no sign of reversal. Though the only good thing is that it's so oversold that it could give a good bounce back. But my sense is that it'll just be a bounce back. So the broader trend is very, very negative over here. Similarly for Hero Motors also, if you look at the charts, the stock peaked out way back in September end and at a price of in excess of 6,000, and now we are down to about 3,500 with a very similar chart setup. So I would avoid them. I think if somebody's stuck, use any 5 to 7% kind of a pullback, bounce back to sell and exit.
Okay, all right, Mitesh. Thanks very much. We'll come back to you in a bit for some more ideas. Right now, market's holding fairly steady. Now, what are the signs that a market could be turning around? Ramdev Agrawal of Motilal Oswal Financial Services says that promoters could start buying their own stock from the market over the next 2-3 months, and that could be a significant indication that maybe we're past the worst. Take a look.
In 2-3 months' time, when promoters will actually come to buy, because they're the guys who are the smartest. They know the value of the company. So when the promoter starts buying, so actually you can't see that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price of multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected.
All right, so when promoters start buying their own stock, maybe that's a big indication that the worst is over. Now, Nigel's been looking at some of the companies in the metal space, right, where there's some evidence of this already happening?
All the spaces, actually. Surbi, just last week itself, since the mood was very, very somber, I said, let's go in and look at where the promoter is buying into their own stock. I'll tell you what, there are a lot of buy and sell side analysts. But the best analyst on their company is the promoter himself. He knows the worth of his company. And if he really wants to back it up, he'll go in there and buy some shares, particularly since most of these shares have fallen 10, 20, 30% from the top. And last week itself, I pulled out some data. Now, before we get to what happened in February, just yesterday, post-market hours, TD Power, that's one of the promoter entities, they went ahead and they disclosed they bought only 15,000 shares from the open market. The market likes that. They saw that filing yesterday, and this buying was done in February, but the filing was given yesterday. So that's why that stock, in fact, it's taking some heart from it. It's up close to around 5%. But there have been some larger promoter buys that we saw in February. Case in point being JSPL. I recall their numbers that they gave had caused a bit of a scare because of the capex that was up. The promoter came in there, bought close to 100% from the open market in the month of February. And now the promoter holding has gone up to around 62% from around 61% or thereabouts. That's close to around 600 crores or thereabouts at current market price. So big money being put in. JSPL is one stock. The next one is Maharashtra Seamless. We had the management join us on the show as well. And I've seen it in the last few quarters itself. Every time the stock is a little bit weak, the promoter comes in there and they chip in. So from around that early 60%, now it's moved to close to around 68.5% or thereabouts. So that's the other stock. The other one is Quest Corp. I recall, close to around 6-7 quarters ago, the promoters were buying from the open market. To be precise, in the March 2023 quarter, they went ahead and they bought more than 4% from the open market. And off late as well, they've marginally increased their holding by around 0.4%. The street likes that. The stock has seen some support from those levels. Well, the other couple of names that we have seen in the last few quarters where there has been promoter buying, Gateway Distriparks, that's the promoter entity of Snowman Logistics. And the management has been telling us that they want to increase their stake. They want to make the company from an associate company into a subsidiary. Precisely what's happened. 40 to 50% is what the promoter entity holds now in the company. Faircam Organics as well. We don't talk too much about this smaller company. But the promoter entity, I'm just looking at the filing from December in comparison to September. They bought 2.5% from the open market. And Mangalam Cement, over the last few years, I've heard a lot of rumor about whether or not there is some corporate action on the cards. We'll wait by in case that's true. But for the time being, the promoter entity has shown the faith, gone ahead, increased stake by more than 1.1%. So as Ramdevji said, that this could be one of the indicators out there. He expects more of the same in the coming months as well. Just thought we'll elaborate and put down a few of those stocks. Deepak Shenoy joins us on the show. Hi Deepak, good afternoon and good to see you. When Indian market's not doing too bad today, so that's pretty good news. And hopefully India knocks off the Australians later on in the day. For the time being, the Australians are bowling in. So I guess in the evening, we'll get to see Rohit, Kohli and company, all of them, take to the pitch and in fact, score some runs. But what about the markets and this promoter buying? The street seems to be liking it quite a bit. And, I think in times of trouble, you want the promoter to go ahead and back your company. Your take, any of these stocks on your radar?
In fact, I think we've been monitoring a few other things here, including system-driven disclosures, where if a promoter buys, they don't have to disclose it themselves. The system discloses it automatically on the exchanges. We're seeing some early stages of promoter buying, and promoter buying in general is a better indication of direction than promoter selling. Promoters usually sell for very different reasons. Most times it's not valuations. But when they buy, it's typically that they find value in the stock and they want to increase their position and so on. So I think promoter buying is actually a good thing, but it's very, very early right now. I think we've probably seen the first signs of something. In general, I expect to see a lot more happen in March, because most companies don't allow promoters to buy until the results are announced. So there'll be a window after April 1st till when they announce results, when they will not be allowed to buy their stake. So they will be able to only buy now. So this will be a month where I think we'll track the activity a little more. We don't have any positions in the stocks you mentioned, but we're looking at a lot of the companies where we're interested, where we're seeing, we're looking for whether promoters start to buy in that space. That gives us some more of an idea, maybe not, some confidence more than anything else. But by and large, I think the numbers are not significant right now.
All right. Deepak, I wanted to ask you about the two-wheeler majors. Clearly the street is quite cautious on them. Bajaj Auto, Hero MotoCorp, in a market that's actually recovering, both those two are seeing aggressive selling pressure. And the fear is that the economy itself is slowing down, which could be a factor on a temporary basis. But how would you approach these names? Bajaj Auto is now at a 52-week low. We had the management, Mr. Sharma, earlier today, and he was actually saying that he'll treat this as a one-off, and he's actually optimistic about the path ahead from here on. Your take?
So, I mean, they've had a very disappointing February as well. I think, Nigel, we've seen the numbers. Hero was not good at all. The rest were okay. I think at some level, there is not yet a meaningful recovery in auto two-wheeler sales since 2018 or so. I think if you look at the numbers, at one point, I think there was 7 lakh two-wheelers sold per month. And since then, we've really not been able to come close to that figure. More than 8 years or nearly 8 years now, or 7 years now, since those numbers have come, and we've had a very prolonged slowdown. I think in some way the market's kind of tired of this, and when is this recovery really going to come? But I feel like there's nothing wrong fundamentally here. It may be that the love has been spread across more two-wheeler manufacturers, including the electric vehicles, and there has been no meaningful innovation in the two-wheeler space in the last few years. So at some level, if you've got good vehicles that are running, there's not so much additional demand coming to two-wheelers. Possibly more is coming towards four-wheelers, which is probably a good thing, for the economy in general. So at least at this point, I think it's a lack of innovation in the space that has probably hurt some of the two-wheeler manufacturers. TVS, on the other hand, has been doing okay. I think even now, recently they have not done so well, but in general, they have been the more innovative of the pack. Bajaj Auto probably the second, and Hero probably the last in that regard.
Yeah, actually, we asked him exactly that. I mean, what is the real issue? And he clarified, just to put it on the table, Deepak, that he said that it's not because there's any issue with financing, lack of financing, nothing of that sort. He just said it's mood and sentiment, which seems to be a little downbeat. But he seems to be confident that by end of this month or early April, things will change because the tax cuts flow in, you know, the respite from some of the GST reductions, comb, etc. A lot of those factors perhaps will stir up demand. We'll see. But yeah, weak numbers, no doubt, for February, for Bajaj as well as for Hero.
And he also said that the consumer buying behavior has also changed, influenced by the mega trends in e-commerce. So, you know, like you have those Black Friday sales on e-commerce, many of the, consumers are timing their purchase in order to get the best deals. So he's not too worried about the dip seen in the month of February. Consumer buying psyche for discretionary spending has also changed. But let's get on to the news from the insurance space, because sector regulator IRDAI has warned health and general insurers against rising commission payouts. Yash is here with the details.
Well, that's correct, Rima. There's been some tough talk coming from the insurance regulator IRDAI to the general as well as health insurance companies. What is the primary concern of the regulator? It is simple, that the general and the health insurance companies are spending excessively when it comes to commission payouts to their various distributors for selling health and general insurance, other general insurance policies. Now, if you remember, about 2 years ago, April 2023 is when the regulator had given the industry the relaxation on removing limits on which existed on commissions and shifting those limits to a headline expenses of management limit. Now, what does expenses of management include? It includes commission as well as other operating expenses. So the regulator gave them, the insurers, a free hand to decide how much they want to spend in terms of commission. But at the same time, on the headline with respect to expenses of management, it should remain under a certain limit. Now, what the regulators observed in the last 2 years, as per our sources, is that the insurance companies are spending excessively when it comes to the commission that they pay out. Compensating for that excessive commission payout, they are reducing the operating expenses and hence staying under the headline limit of expenses of management. What that has done, according to the regulator, is that it has restricted the premium pricing or the premiums that policyholders pay towards various insurance products. It has restricted those prices from coming down. Hence, the benefits haven't really been passed on to policyholders. The regulator has done some tough talking, saying that reduce the commissions, contain the commissions that you're paying. Otherwise, it would be forced to bring back those limits on commission level itself, moving away from that relaxation of fixing the limit on the expenses of management side. The review for the expenses of management regulation happens next year. That is at an interval of 3 years from 3 years ago when it was implemented, 2023. And hence, this could come under the review where the regulator could decide on changing those limits and putting it back on the commission level itself.
Yash, I just want one clarification. If you could just demystify this. Now, even though the commissions have gone up, what you're saying is that the insurance are still the insurers, they're still within the headline cap,
Correct.
Which is total expenses. So how is that impacting premium pricing?
So it is very simple. Just to demystify the concept of total expenses, it includes two things: commission as well as operating expenses. Now, commission is something which directly impacts the price of the insurance product. So if a product is selling for 100 rupees of premium, 8 rupees is, let's say, assuming the commission which is paid to a policy holder, it is 108 rupees, right? If the commission becomes 11 rupees, then the cost of the product for a policy holder becomes 111 rupees. At the same time, if the commission is reduced to 6 rupees, the cost reduces overall cost to the policyholder to about 106 rupees. And that is where the regulator is saying that the commission is not coming down, and hence the cost of the product, which is the premium to a policyholder, is not really coming down.
Okay, got it. So basically, pricing is far more directly linked to the commissions than to overall headline expenses. Got it, Yash, and that's why the regulators sort of not too happy with the way this is going. Thanks for that story. Deepak, insurance. Let's talk general and health first, if you have any interest over here. Never a dull day when it's insurance, right? Either regulation or taxation or something or the other is always happening. Your views, general insurers?
So I haven't seen anything major in general. We don't have any exposure in general. Is there something that has happened recently? I've not this thing paid too much attention.
No. Deepak, this was just a story that our colleague Yash had just put out, where he was explaining how the regulator is watching the high commissions very, very carefully. Yeah, okay. And maybe, it comes down with some sort of definitions because those commission levels are high, which is why premium prices are quite high. You don't have any exposure to general insurers, life insurers, or a platform like PB Fintech. Any thoughts there?
Yeah, no. So I think we have exposure to life insurance companies, but then in general, I think the commission structures has gone through a very different sort of a route. If you remember 2 or 3 years ago, there was this issue where a lot of these companies got GST notices because they were somehow getting paid by the insurers as something that was not commission, but was marketing expenses, and marketing expenses were capped to a certain level, and therefore, a lot of these rules were requested to be changed. Eventually, what the insurer IRDA said was, take the total marketing expenses and put it under a cap, and in general, don't try to put sub-level caps for everything. And now it appears that the commissions that are paid to intermediaries is the problem. So they have kind of warned about it. So typically regulators do initially warn. There are a lot of times when commissions are introduced at a very high level in certain products. ULIPs at one point used to have 100% commissions on the first year or first 2 years of premium. So your money would only get allocated to something that's invested about 3 years after you start paying your premiums. Then IRDA came down harshly and things have improved since then. So I think now what they're doing is just warning people that, if you introduce high commission products, you'll have trouble. Companies that are either wealth managers or people like PB Fintech perhaps will see the impact of it either directly or indirectly over a period, especially if regulation comes in that limits these numbers.
Well put. Thank you, Deepak, for explaining that. And thank you for joining us today. We'll slip into a very short break. Before that, here is a message from us. Parity isn't just a goal. It's the key to unlocking new possibilities. HSBC presents CNBC-TV18 Future Female Forward, the mega summit co-presented by Cognizant, where we will discuss what it takes to close the gender gap and create lasting impact. Tune in for this game-changing dialogue live on CNBC-TV18, 10th March, 5:30 p.m. onwards.
Welcome back. Well, the market's still sitting with a cut-off closure around 20 points or thereabouts. I guess, won't be surprised if by the end of today, actually, we move into the green. That's the kind of market that we have today. We had a pullback and we're sustaining out there. Just one more point, these OMCs, they're rejoicing this fall in crude oil prices. If you look at BPCL, HPCL and IOC, I recall, at around 950, 920 as well, we had pointed it out that these could be the stocks to track. All of them are at the high point of the day. Even I think Interglobe has moved up. Temporarily had a bit of a pullback. But I think that one, because this means that the ETF prices as well will be well behaved going ahead. So that one's up close on 3%. And we know that the traffic has been very, very good. Aditya Sood, fund manager at Incred Asset Management, joins us on the show. Hi, Aditya. Good afternoon. Good to see you win. A far better day to join in, Aditya. The markets have been bruised and battered actually in the last few trading sessions. The mood has been very, very somber. Tell us, how are you all approaching markets? Are you all buying, sitting on cash? Do you think the time has come now?
I think so. It is a bit of combination of both. One is that, since March of 2023, when markets went relentlessly up for 16 to 18 months every month, who would have thought that we can have, 5 months of Nifty going down, every month on month. Normally in a bull market, you have an element of markets rallying, once, you have seen bit of oversold territory, but this time around, obviously, the fall has been relentless. Obviously, the framework that we have been using is that, every bull market has a element of correction that comes through. Bull market corrections are very, very sharp, treacherous. I think so. It is about time wherein investors start to think more about return and less about risk. Possibly, risk has already played out in the portfolio in the sense that, many stocks are down, 30-40%. Another thing that we are very anchored towards today in this environment is that, you had 4 years of 25% plus earnings growth getting delivered in the market. And obviously you had certain sectors which delivered, earnings growth in excess of, 30-40% also. That obviously created excesses in the market. And we are in an earnings reset environment now. So I do believe that coming 2-3 years are going to be very, very different than what we have seen, post COVID, in terms of earnings growth environment. We are watching out for companies in this environment wherein multiples and earnings both have been cut, and whether promoters and insiders start to buy. I think so. This is a very, very interesting combination to look out for, and obviously that would mean that you could have asymmetric return opportunities as we move forward, over next 6 to 12 months.
Aditya, you said it's going to be very different next 2 to 3 years. It's going to be very difficult or different?
I think so. Different and difficult both, in the sense that once you have this environment. So if you look at the earnings growth trajectory broadly, last 10 years, we have compounded at 12% CAGR, which is nothing but the nominal GDP growth rate in the country. And you had 4 years wherein, earnings compounded at, in excess of 20%. Obviously, that led to, excesses coming through. But I think so. We would like to be in areas wherein earnings are fairly protected or insulated. So that is point number one. Point number two is that, obviously, the valuations are much more reasonable, not necessarily in the new stocks, in the set of stocks that we already own, than what they were, 6 or 9 months back. And these companies, as long as they continue to deliver on earnings growth rate, I think so, we would be better off in comparison to the market.
So Aditya, in terms of fresh allocation, are you buying more of the same? Because we've spoken about stocks like Newland, Thyrocare, Federal Bank, Tejas. These have been some of your bets in the past, which we've discussed. So are you buying these, topping up these, or are there any new ideas, any fresh purchases, the first time investing in any stocks? So and tell us about them.
Yeah, so essentially it is a two-pronged approach. One is that we are looking at areas wherein there have been, combination of earnings getting brutally cut. Obviously, MFI is a sector, wherein earnings and multiples both have been cut. And, now they are, most of the, sort of MFI companies are trading at closer to the low that they made during the COVID time. So that is one example. We find value there, not necessarily that we would, go down the ladder. Essentially we would buy the MFIs which have managed or who have a consistent track record over the last 4 or 5 cycles of managing asset quality well. So, that is clear-cut example. The second example also is, areas wherein we see a very good dividend yield. And in a market like today, that dividend yield is going to be a combination of having support in terms of stock price. Secondly, we are closely looking at insider buying data. So if you could get promoters who are backing their companies essentially and buying more of the stock that they already own, it is a very, very good combination. So if you look at some of the PSU names today, essentially I can find stocks which are trading at a low double-digit PE valuation and having 3.5%, 4%, 5% dividend yield potential. Obviously, OMC is being, one of the areas which is looking very interesting from a dividend yield perspective. A large cap like Vedanta, offers considerable value purely if you look at, dividend yield today. So essentially, I think so. These are areas wherein you can do some value buying. And this market is meaningfully different because in the past, 6 months back, had you imagined that, you can find a dividend yield play with a low price to earnings multiple. Today, possibly, whatever way you want to position yourself as an investor, it is possible to construct a portfolio. Be it a dividend yield investor, be it a growth at a reasonable price investor. You can position yourself beautifully in this market.
Okay, so at least it's got some excitement going for real stock pickers. That's what you're saying, Aditya. Got that point. So dividend, you've given some examples, Vedanta. You're saying could be an example where the dividend yield play can work really well. Also, of course, company's going through its own, corporate restructuring, and then the division has to happen in 5 different entities. But on the other piece, growth at reasonable price, because that almost never was happening in this market for the last 2-3 years, right? Give us some examples of that, where there's growth, there's some valuation comfort, and things are looking not too bad.
Sure. So essentially, if you look at our top holdings like Indraprastha Medical, Tejas Network, or, Newland Labs, I think so all the 3 stocks fit into that category. So if you look at, Newland as a case in point, last year they made a profit of 300 odd crores. Our forecast is that, possibly we are looking towards, doubling the profit trajectory over next, 2 to 3 years. If I compare Syngene, Newland and Divi's, in terms of the ROC profile of these companies, because each of these companies are very similar in terms of, bucketized into the CDMO play category. If I look at the PE ratio, both on forward and trailing basis, I think so Newland is the cheapest of the lot, possibly the highest return on invested capital. And if I look at the EBITDA margin profile also, possibly, it is very, very attractive. Similarly, if I look at essentially Indraprastha Medical and compare it to the hospital universe, the multiple is half of the universe. The ROC is double of what the universe is generating. And I think so the earnings growth profile is going to be materially different over the next 4 or 5 years once they get into the capex mode. They have not done any capex for practically last 25 years, and now they are getting into a free cash flow yield zone of 8% plus, and now they are getting into a capex mode as well. So I think so these are very, very interesting opportunities, because what it essentially also means is that you are buying into a combination of earnings growth which is superior than the market earnings growth. So the second thing is that superior quality in terms of return on invested capital. And the third point is that whether there is scope for P multiple to re-rate in the next cycle. That is, I think so that is very, very important. So in a market like today, that is the kind of opportunity that you are witnessing. Multiple can now also expand over a 3 or 5 year period.
There are 3 interesting examples: Tejas, Newland, and Indraprastha Medical. And quickly, just 10 seconds on this. Are you willing to venture into any of the erstwhile highly sort of valued stocks, which were promising growth? There was a narrative, but the valuations were a problem. Whether it's EMS, names like Dixon, etc., whether it's defense, or even your capital good majors like ABB Siemens. Are you buying anything there where you think now valuations look better, or would you skip?
I would say that I would, skip, because, this is a market wherein you can buy a combination of low multiple and earnings bottoming out. So why would you go and buy a company, which is like trading at 50, 60 times earnings multiple, and, you see limited scope of P multiple expansion. So one of the areas wherein you need to be extremely careful is wherein multiple can cut further, so let's say you end up buying a stock at 40 P, and suddenly you realize 2 years down the line that market has derated the stock at 20 P. So why would you buy that kind of a combination? So all the popular themes which are fads in the previous cycle, be it, solar, EMS, we will strictly stay away from.
Avoiding. Okay, not going with the earlier fads, looking at value elsewhere. Got it. Aditya, thank you very much. Helpful conversation. Good to have you on the show today. With that, let's quickly head to Nimesh, figure out what the chatter is like on the street. Nimesh, so at least it's not that bad, right? In the morning, it looked like it would be a horrible down day, but relatively not too bad?
Oh, absolutely, Surbina. In fact, I would say it's a very matured reaction from the Indian markets today. Given the kind of global cues, we are pretty much in the green. And the heartening part is that the mid-cap index is bouncing back very strongly. The mid-cap index has recovered almost 2% from the intraday lows. A lot of individual names are buzzing in trade. And I would say, this recovery in the broader markets is backed by some bit of institutional buying as well. So while the overall flows are quite mixed yet, there is a bit of selling in large caps, but it's a small cap where there's a small nibbling happening from domestic funds as well as some large HNI investors as well. Remember, even yesterday there was a feedback that you will see a large DI number, and that turned out to be, and the feedback was that a couple of domestic funds did basket buying as well in yesterday's trade. I'm not too sure about today's large number, but at least there is small nibbling happening, is what I understand, in the broader market names from domestic as well as HNI investors. So that's the overall feedback. Technically, now 21,800 will act as a very strong support on the downside. That's a very important level to watch out for. And now 22,800 will act as a very strong resistance as well on the upside. In terms of sectors, today two specific sectors stands out in terms of institutional interest. One is banks. Select banks are well built, and some bit of interest seems to be back in the PSU names as well. So again, very selectively in both those sectors, but there is institutional interest in both those sectors, especially banks and PSU stocks.
Indeed, Nimesh. And what about stocks? What have you picked up?
So the first stock on my list is Kaynes Technologies. Well, the stock is under pressure today, despite the fact that there is an upgrade from a sell-side analyst. There are reports about an overseas acquisition as well. I understand largely the under pressure could be because of the fact that there is a buzz of a very large block coming in Kaynes very soon. So there could be a supply overhang, at least in the near term, on Kaynes Technologies. So that's the first stock. The second stock is GMR Airports. Again, that stock has recovered sharply from the very recent lows. You know, stock is sharply seen a very sharp correction of late. And now at these levels, some bit of HN interest seems to be back. I understand a very large influential investor has started buying or nibbling into GMR Airports at current levels. So that's the second stock. Third, Jyoti CNC and India Cements. You know, both these names stood out for me because there are very small buy flows, but look at the reaction in both the names today. Jyoti CNC, last I checked, was up 16%, and so was India Cement up 12-13%. So even though there are very small buy flows, but at least the institutional interest is back in some of those mid-cap and small-cap cash stock names. So that stands out for me. And the last is Biocon. Within the pharma names, again, you know, it's an extremely beaten down stock now, and now at these levels, some bit of HNI interest is back in Biocon. So that's the reason why even Biocon is buzzing in trade today.
All right, Nimesh, you know, I'm waiting for to hear what I heard a month or so ago when you said, Nigel, today I'm sticking my neck out and the FIs will be buyers. It's been a while, Nimesh. Let's hope in the coming weeks we hear that again from you.
Well, Nigel,
it's been a long while.
The day I have a feedback, Nigel, I will tell you. I mean, you know, again, this is all the feedback that I pick up from institutional dealers and sources. So the day it has to happen. See, yesterday I was quite confident that the DI number will be strong, and it turned out to be.
Bang on, Nimesh. Thanks a lot for that. Well, time to slip into a short break. Up next, Prashant has two very special guests waiting by to discuss the big global reset. Slip into that break, come back. Prashant's waiting for us on the other side.
Hello and welcome to this special program. We are calling this the Global Reset under Trump 2.0. I'm Prashant Nair. The new U.S. administration under President Trump seems determined to upend the world order as we know it. From tariffs to security alliances, everything seems to be up for negotiation. How does one navigate this changing environment? That's the big question. I have with me someone who tracks all this very, very closely. Louis Gave is the founding partner and chief executive officer at Gavekal Research. Gavekal is a financial services company. They do research in global markets, global economics, based out of Hong Kong. Gavekal is widely followed for their institutional research, commentary on daily global macro events, and of course some of the bigger trends as well. I also have with me Manish Bhandari, who's director at Valum Capital, a fund management business based right here in Mumbai. Gentlemen, great to have both of you here. Thank you very much, Louis and Manish.
Thank you. Thank you for hosting us.
Thank you so much for having me. Us.
This is an extremely interesting time. A lot of things, everything seems to be changing.
It sure is. Definitely keeping busy. Lots to think of, lots to write about, lots to stay in business for.
So let's start with what is most current, most recent, right? Tariffs, Louis. How real are these tariffs in terms of their durability?
Yep.
Because the Canada-Mexico tariffs and, of course, the 10% extra tariffs on China, they seem to be motivated by sort of essentially stopping the flow of illegal drugs into the U.S., right? It's not to raise revenues, at least that's not the stated objective. So is this going to off-ramp at some point, or you think this is here to stay? These tariffs particularly?
I think you put your finger on it. The big question is, are the tariffs a tool towards achieving something, or are they the end goal? I think so far there's still a lot of signs that Trump is looking at tariffs like a tool to achieve something else. Now, fundamentally, what does Trump really want to achieve? I think the first goal right now, what seems pretty obvious, at least to me, is that contrary to Trump 1.0, who kept tweeting about, the stock market making new highs, and what they're really worried most about is three things. They want to get the bond yield down, they want to get the US dollar down, and they want to get the oil price down. And pretty much every one of these policies that they've implemented, now there's other things, yes, they want to stop the drug flow, etc., but everything they're implementing is really driven by these three goals, and including the tariffs. For me, and I could be wrong on this because it's very hard to predict what Trump is going to do next, but for me, the tariffs remain a tool, and it's a tool that you're going to use to beat up America's trade partners, whether Japan, whether Korea, whether China, and to say, look, guys, I'm going to tariff you unless you go out and you buy U.S. treasuries and unless you raise the value of your currency. I think the next few months we get a lot of this until basically Xi Jinping and Trump meet in May, and then we'll have a better outlook on whether tariffs are here to stay, or whether some kind of Mar-a-Lago Accord, to use Scott Bessent's term, whether some kind of Mar-a-Lago Accord gets achieved.
Are the three things you mentioned consistent with a higher stock market?
I don't think it's as much of a priority, to be honest.
That's an interesting, important point, because, the general assumption is that he's very focused on the Dow being at a new high. It's like a point of pride. But you're saying actually the target this time is not higher stock markets, it's lower cost of borrowing.
I think so. You'll notice this time he hasn't tweeted once on the level of the stock market.
Okay.
You've had tweets from Elon Musk, you've had talks from J.D. Vance, from Scott Bessent, from Trump himself on the 10-year yield. And I think the reason for that is actually the setup today in the U.S. is completely different.
Yeah.
The big problem is in the second half of this year, you have a massive amount of debt to roll over. Because remember, in the second half of 2020, interest rates were at record lows. Every single U.S. corporate went out and issued debt. When interest rates were below 2%, you're a CFO of a company, it'd be criminal not to issue debt. They all did it, and most of corporate debt in the U.S. is 5 years. So now, these guys all have to roll over the debt in the second half of 2025. If they roll over at much higher rates, that means that CapEx is going to get cuts. That means that employment is going to get cut to pay for the debt. They have to get the cost of debt down. Without that, you're facing a really bad 26, and guess what happens in 26? Midterm elections. So take the pain up front, get the lower interest rates so that the economy can be rebounding by 26 on the back of lower energy and lower interest rate costs.
Okay, let's just complete the tariff point.
Sure.
So I think average tariffs into the US are 2.5%, 3%, somewhere there.
Yep.
By the end of the year, where do you see those?
That's a really tough question because I think a lot is going to depend on those negotiations with China.
Okay.
And here...
But they're going to be higher. We don't know.
I think they're going to be higher because part of, I think, Trump's view of the world is foreigners should pay more. Now, I'm not quite sure how he came to that conclusion, but essentially one of his hardcore beliefs is foreigners have been taking advantage of the United States and they need to pay more. And a lot of these policies, like the golden visa thing, where foreigners are going to pay $5 million to move here, even though you already have an EB-5 visa that costs $800,000 that only 2,000 people take a year. Somehow millions are going to take the $5 million option. There is this perception of foreigners have to pay. So yes, there will be higher tariffs. The big question is, will it be marginally higher? So you say 2.5%. Will it be 10? Will it be 12? If that's the case, that can sort of come out in the wash. Like if you got a 10% across the board, that's not going to throw the global or the U.S. economy off the rails. If you move to 25, 30, then all of a sudden, that's much more problematic for global growth.
Okay, let's talk about what is important for emerging markets as well, which is the US dollar. You're saying he wants the dollar lower, and so far it seems to be working.
Yes.
Right? Yields are down, I think, about 50, 60 basis points in the 10-year over the last 1.5 months. Dollar is lower as well, the broader dollar. What's your sense, Louis, here?
Well, look, I think when you look at Treasury Scott Bessent, Treasury Secretary Bessent, his very first thing when he got into his new office was first thing he did was to pick up the phone to call his Japanese counterpart and to essentially tell him, look, the yen is too low, which it is. The yen is ridiculously low. If you spend any time in Japan, it used to be that if you went out for dinner in Japan, you'd have to check your bank balance to make sure you could afford dinner. And now, you go there and, things are really, really cheap. So bottom line is, the U.S. does want a revaluation of Japan, does want a revaluation of the won, the Korean won, does want a revaluation of the renminbi. That's going to be, obviously on the table with the discussion with Xi Jinping in May. I think there's a good chance that gets achieved because all these currencies are today massively, massively undervalued. The U.S. dollar is very expensive. You go travel in the U.S. today. For most of my life, traveling to the U.S. Was a, decent value experience. Today, it's completely out of whack relative to everywhere else in the world. Yes, the U.S. dollar has to come down. It's too high.
But Louis, isn't it quite conflicting that you are you're doing the fiscal consolidation, and there is a possibility of a dollar going down? You're just talking your way through, or you really want to implement? You can really push this through?
Yeah, that's a great point. You're absolutely right to highlight that usually fiscal consolidation, you tend to have a bit of a stronger currency. Now, having said that, in the past 2 years, you had massively pro-cyclical fiscal policy in the United States, and the dollar still went up because, at any one time, I think you have many factors can impact a currency. Yeah. And in recent years, the biggest factor impacting currency has been interest rate differentials because the U.S. yields were going up, U.S. dollar was going up. If they're going to be successful in bringing yields down, then partly through Doge, partly through cuts in government spending, maybe a little less issuance of treasuries than the market had expected, maybe arm twisting China, Japan to buy more bonds, a little bit of this, a little bit of that, get yields a bit lower. I think the U.S. dollar does roll over from the current level of overvaluation. I think it's happening, actually. It's already starting.
And I think it'll be good news for capital flows into emerging markets if that were to happen as well. Of course, the other stuff will play out as well. The other thing is the market here in India has been weak. I think the market here in India and the US have been very, very tightly correlated. Two best performing large markets in the world last few years. But here we've started to pull back. US, the S&P is just under 5% away from its all-time highs. Do you think we're starting a correction in the US as well, especially large cap tech, which actually is the only space which has mattered, which has driven the US outperformance, is the top end there? Your thoughts?
Yes. No, I think we've just had a massively important event with DeepSeek. DeepSeek changes the world we live in. It changes it on many different fronts. First, until DeepSeek came around, the perception was that the US could contain China technologically. The fact that China all of a sudden shows that it's at the same level on artificial intelligence as the US shattered this illusion. The second reason it mattered is that up until 10 minutes ago, the widespread belief was that all these huge Mag 7, these big cap tech stocks, could in essence build monopolies for themselves through unprecedented capital spending. That if you wanted to play at the AI table, you needed to put 50 billion a quarter on the table as your ante. DeepSeek has also shattered this belief. And so all of a sudden, the idea that you can spend your way into building a monopoly for yourself, into building ever bigger moats, has been completely undermined. And I think with that, you have started to see a rotation in the market where, indeed, investors start to say, well, hold on. If Microsoft, Google, Amazon, if they're not going to be the massive monopolies I thought they were, do I still want to pay 35 times earnings, 40 times earnings? Especially if at the same time, you're starting to get other stories around the world. Now, you pointed out, in recent years, there's been only a handful of stories. There were really three. It was gold, US tech, Indian equities. That was it. Like anything else you did was kind of lame. But now what you've seen is while the US starts to fiscally tighten with Doge, China is fiscally easing and starting to do a lot of pro-consumption measures. Europe is fiscally easing. And so as the fiscal easing shifts from the US to China and Europe, lo and behold, China and Europe start to outperform. All of a sudden, there's other things to do in the market. maybe I don't need to just own Microsoft at 35 times earnings. There's other exciting things to do.
There's some very interesting graphics, as you were talking as well, from your research, which you're putting out for our viewers. We will continue this conversation, Louis, and I want to sort of connect that with flows as well, right? I mean, there's always this debate whether when money goes into China, we get our money through EM funds.
Yes.
So if China gets money, we get money, or is it, I mean, one at the expense of the other? We'll sort of ask you that. Let's just take a quick commercial break here. We're going to come back, continue this very interesting chat with Louis.
Welcome back. We're in the final leg of closing bell, and the market for the time being is, trying to hold on to a little bit of green, though there's some volatility. Nifty is now about 40 points lower. So let's see what the final close turns out to be. Jay Bala is with us. Bala, always a pleasure having you on, and you've been right all along in calling this fall. But now let's talk levels. We were speaking to, someone yesterday who was also looking at some technicals, and that one view was that we will actually go past the election day lows as well, and then only find some support around 19,500. But I don't know. I mean, you tell us how close or how far away from the bottom are we?
Thanks, so good to be here. And I know you guys have been quite graceful in acknowledging that I called it correct. And when I called this markets to decline, Nifty to decline to 21,280 on the 1st of October, the Tuesday 1st of October, I had three options in front of me. One was this 26,277 was a long-term top, very long-term top. And the second one was a deeper correction than I had projected. And the third one was the one correction I projected to 21,280. The reason I'm bringing this is about the market has come to where it is now with a very strong momentum. The momentum is intact. So usually momentum wanes when the market's trying to bottom, but that sign is not there yet. So the next character of the bounce the market does is going to be extremely crucial. And if it were to be corrective, I mean, it's a technical term, and that evaluation will be done by technicians, and we can conclude after that. But if it were to be corrective, there's a good possibility that this correction is likely to drop to something like 17,800 on the Nifty. Another reason is the global markets. The tech semiconductor index had topped in July 2024 and has not crossed the all-time high. And I can conclude from the monthly charts of the semiconductor index and the NASDAQ 100 index, there is a very good possibility that the recent highs of July in the stocks and in December in the NASDAQ 100 is a long-term top. So if that were to materialize, there's a greater probability that the Nifty's drop to 17.8 would increase. But currently, the September to November decline and the January to present day decline is equal. What we call in technical parlance as A equal to C. Usually, markets tend to give some kind of relief rally or bottom. So we'll be very closely evaluating what the market does over the next couple of weeks.
Okay, all right. So Jay, but you believe that we'll have a relief rally from here? It's a possibility from if 21,800 holds out, then we see a 1,000-point rally, and then we go to 17,800.
Yeah, there's a good possibility. It's going to be support is coming in at 21,800 to 21,300. That's a support for Nifty. The relief potential is something like 22,650 to 725, which was the February 18th low. That former low becomes the resistance now. So that is one projection. Or it gets a little bit higher to something like 23,100. But more likely it could be 22,650 to 22,725. Yes, there is a potential for a short-term pullback. And the banking index is holding relatively well. And my candidates for a counter-trend bounce should be coming from the capital goods, realty, metals, and Nifty PSE. And all of them are counter-trend bounces. There have been long-term damages done on the Nifty Auto, Nifty FMCG, and even Nifty IT is at the precipice of a very important trend line from 1996.
Very quickly, Jay, talk to us about the global indicators and what the setup is for U.S. markets, the key indices, Bitcoin, gold, the 10-year bond yield, because this entire U.S. exceptionalism is getting challenged now.
That's right. That's right. See, Bitcoin, I had mentioned 3 times in December that it's coming to a very important long-term top, and it had potential to halve from the all-time highs. You know, if Bitcoin doesn't hold 72K to 75K, it's very likely that it's going to at least 49K, if not 18K. So that's a bit, confusing even for me, given that Trump has just announced a sovereign holding of selective cryptos. But the technicals is that's what it's saying. But let's watch 75,000 to 72K on Bitcoin. That will be a signal of animal spirits going off. And when it comes to the US Treasuries, I might have to revise the short-term outlook that it's rising higher. If it breaks 400 bips, probably it's going to somewhere close to 300 bips. That is probably telling you, again, flight to safety, moving into the bond markets, probably. And when it comes to the precious metals, gold has probably got one more record highs to come through. It's not completely clear whether it comes first to 24,000 and then goes to 3,200, or straight away goes to 3,200. And whereas silver is unlikely to clock fresh 52-week highs. And dollar index, it's crossroads. Yeah, either the dollar index has already bottomed or it's going to break down very soon. It depends on what the USD JPY does.
Okay.
And if the USD JPY strengthens, we have a reverse carry trade. Again, negatives coming in for the equity markets.
Okay, the bell has gone, Jay. Just hold that thought. Quickly wrap up the day. And the day is going on a very flat note, 38 points lower on the Nifty. The mid-cap index is ending absolutely flat, but the story lies in the intraday recovery. Massive intraday recovery for the mid-cap market from a 2% decline in the morning, and the advance decline ratio is still positive. Over 1,500 stocks advancing, about 1,100 declining. Just very quickly, some trends. PSU stocks have done really well today in the recovery. So the likes of SBI, BPCL, BEL, Coal India, ONGC, Power Grid, long list of winning PSUs. The auto majors, and especially two-wheeler makers, they have received a bit of a drubbing. Bajaj Auto is ending 5% lower. Hero is about 3.5% lower. Eicher is down. Maruti is also down. So these have been the weak hands. And then, of course, some of the big boys that have been sulking today. Lever, Reliance, ITC, Infosys. These are some of the weak names on the Nifty. But, of course, a very good day for the mid-cap market.
Well, that brings us to a close and closing bell. Thank you very much for watching. But don't go anywhere, because on the other side is Markets Forward.